Hi, everybody. This is Alan Ellman, the Blue Collar Investor, and welcome to this BCI podcast number 2 titled Why Covered Call Writing Outperforms the Overall Market. Now, when we decide to self invest and take the time for the educational component, the trade execution component, and the trade management component, we are gearing ourselves to beating the market on a consistent basis. Otherwise, why do it? If we couldn't beat the market, we could simply purchase and dollar cost average into low expense ratio broad market index funds like the S&P 500 fund. And as Ron Popeil, the master marketer, used to say, set it and forget it. However, we are looking to get much higher returns than the overall market. And that's why we would consider using a strategy like covered call writing, the strategy that's been my go-to strategy now for more than 2 decades. So how are we going to accomplish beating the market on a consistent basis with covered call writing? Well, first of all, the basic part of the methodology involves mastering the 3 required skills. And those skills are stock selection, which underlines are we going to use prior to selling our options. Then option selection, what strike price are we going to use? What expiration date are we going to use? Are we going to go in the money, out of the money? And so these are the decisions we have to make regarding the option component of the methodology. And finally, position management, or taking advantage of all exit strategy opportunities once these trades are entered. So before we risk even 1 penny of our hard-earned money, we must master these 3 required skills. Now, if I was to give one reason, in one sentence, why covered call writing will beat the market on a consistent basis, it's simply this: we are lowering our cost basis. This is not rocket science. As an example, if we bought a stock for $33 and then sold the 35 call option for $1.50, our cost basis, or our break even, is lowered from $33 down to $31.50. And that is the reason why we will have greater opportunities to beat the market on a consistent basis had we just purchased the stock without the option component. Now, it is true that we're capping the upside, but that's where the second required skill comes into play. Which option are we going to select? And that can be based on what's happening in the market today, what is our personal risk tolerance, and what are our monthly initial time value return goals. So once we have that all hammered out, we will know which option to select, and that will minimize the disadvantages of capping the upside with covered call writing. Now, as most of us know, the market generally and historically goes up 8 to 10% a year. In this chart, you see how the market moved in 1950 up to 2018 over here, consistently moved up. Now, there were dips when the market went down, and we all have experienced these dips. They make us all nervous and scare some people away from investing in the stock market. But generally speaking, over the long haul, the stock market will, in fact, go up in price. And we want to take advantage of that and beat the market. So we want to do even better than what the market is doing on a historical basis. So how do we create our successful portfolios? Well, let's review. The stock selection skill that we must master involves getting the elite performers from the S&P 500 or whatever benchmark we're using. And that involves a 3-pronged screening process of fundamental analysis, earnings and sales growth, technical analysis, reading a price chart, and then, of course, position management, how to mitigate losses and enhance gains. That's all critical to creating successful portfolios that will beat the market on a consistent basis. Now, with the options, we can tailor our portfolios to what's going on in the overall market And we could reassess the bullish assessment or bearish assessment every month by using in the money strikes if we have a bearish sentiment, or out of the money strikes if we have a bullish sentiment. We can also avoid risky events like earnings reports, a very, very important rule in the BCI methodology. And finally, we must be prepared to take advantage of any and all exit strategy opportunities if share price should decline or go very high, or if there's an ex-dividend date to be concerned about, or if the strike is in the money as expiration is approaching and we don't want to sell our shares. So there are a lot of factors to consider prior to entering the trade, and we must be prepared for all of these opportunities. So just to summarize now, the main reason that we will beat the market on a consistent basis with covered call writing is that it lowers our cost basis. Mastering the 3 required skills will take those returns to the highest possible levels. We must know and understand which stocks should we select, which options should we select, and then once we enter the trade, how do we manage those trades? Many times it won't require any management at all, but when it does, we have to be prepared to take advantage of these opportunities. So there you have it. Covered call writing will outperform the market on a consistent basis, and those are the reasons why. So ladies and gentlemen, I hope you enjoyed this video, and most importantly, I hope you make some money from it. As always, this is Ellman, the Blue Collar Investor. Take care, everybody.